$700 billion. That's how much companies like Microsoft, Amazon, Meta, Alphabet, and Oracle are expected to spend this year alone on AI infrastructure. To put that into perspective, that's more than the entire GDP of countries like Sweden or Singapore. This massive spending wave has become one of the biggest forces driving the stock market over the past few years, and honestly, it makes sense. Investors see this level of spending and assume it will eventually translate into huge future growth. And because these companies make up such a large portion of the market, their investments have the power to lift the entire stock market alongside them. But at the same time, there are growing signs that this spending spree may be reaching extreme and possibly unsustainable levels. Companies like Meta, Microsoft, and Oracle have already reported layoffs as they try to offset the enormous costs of building AI infrastructure. Meanwhile, several major voices in finance and tech are warning that the spending may now be getting excessive. And to be fair, a lot of this sounds very similar to what happened during the dot-com bubble. Between 1996 and 2001, telecom and internet companies spent nearly $500 billion laying fiber optic cables across the United States to power the internet revolution. The demand was real. Companies supplying the equipment were making real money, and businesses like Cisco saw explosive earnings growth. As a result, the stock market nearly tripled during that period. But eventually, problems started to appear. The returns investors expected from all that infrastructure spending never arrived at the speed or scale they hoped for. By 2001, the industry had actually built enough fiber capacity to handle nearly 100 times the real demand at the time. Once investors realized that, fear spread quickly. Telecom companies began cutting back spending. Many went bankrupt, and the stock market eventually lost nearly half its value within just a few years. Now, fast forward to today, and data centers are playing the same role for AI that fiber optics played for the internet back then. This time, the companies building the infrastructure are the hyperscalers, the tech giants, spending hundreds of billions to dominate AI. And just like in the late 1990s, all of that money is flowing through the system toward the companies supplying the equipment needed to make it happen. Companies like Nvidia and TSMC are seeing enormous demand because every new AI data center requires advanced chip servers, networking equipment, and manufacturing capacity. So as capital expenditure from big tech keeps rising, that spending directly turns into revenue and earnings growth for the companies building the AI ecosystem. And that's one of the biggest reasons S&P 500 earnings have gone almost parabolic over the past year. The big question now is whether things have already gone too far. Will these companies eventually start questioning the return they're getting from all this spending? Because if AI investment slows down sharply, it could create a major hit to corporate earnings, similar to what happened in 2001. One of the best ways to analyze this is by looking at something called the US manufacturing PMI. This is one of the strongest indicators of the business cycle, and historically it has done a very good job predicting where corporate earnings are headed. Back in 2000, the PMI started rolling over and eventually dropped below 50, signaling a contraction in economic activity before S&P 500 earnings collapsed and the dot-com bubble burst. We saw a similar pattern before the 2008 financial crisis, and again before the 2020 pandemic recession. On the other hand, when the PMI stays above 50 and trends higher, it usually aligns with periods of strong earnings growth, like the late 1990s, the mid-2000s expansion, and much of the 2010s. The reason is simple. When companies begin expanding operations, they first spend money on factories, equipment, infrastructure, and production capacity. That activity shows up in the PMI before it eventually flows into corporate earnings. So if AI-related capital spending starts slowing down, the PMI is likely where we'll see the warning signs first, long before it appears in earnings reports from companies like Nvidia. But right now, the data is actually telling a very different story from the bearish headline. Instead of weakening, the PMI has moved back above 50 and has remained there for the past few months. If you compare today's pattern historically, it looks much more similar to 1998 than to 2000. That suggests we may still be in the earlier stages of this AI infrastructure build-out rather than the final phase. And if that's true, it becomes much harder to argue that S&P 500 earnings are about to collapse anytime soon. We're also seeing real evidence of this from the latest earnings report. Companies like Amazon, Alphabet, and Microsoft are still reporting annual earnings growth of roughly 20%, which gives them enormous financial power to continue investing aggressively into AI infrastructure. And according to management guidance, spending estimates continue moving higher every quarter, with projections potentially reaching $800 billion annually by 2028. So right now, lack of capital doesn't appear to be the problem. That's why a classic bubble collapse still seems difficult to imagine in the current environment. And because of that, many investors continue keeping strong exposure to this long-term AI trend. One of the clearest beneficiaries so far has been semiconductor stocks, which are seeing record earnings growth thanks to the AI boom. But beyond semiconductors, there are several overlooked sectors that could benefit massively from the next phase of this infrastructure expansion. The first is nuclear energy. Large tech firms have repeatedly stated that nuclear power is one of their preferred long-term solutions for generating the massive amount of electricity AI systems will require. The second is base metal. Materials like copper and aluminum are already benefiting from the AI boom because they're critical for building data centers, electrical grids, and energy systems. Since the launch of ChatGPT, these metals have performed extremely well, but some analysts believe the trend could accelerate even further. During the infrastructure boom of the early 2000s, copper prices surged nearly 400%. And considering how far copper still lags behind gold historically, another major move higher wouldn't be surprising. Finally, energy infrastructure companies could also become major winners. As AI increases electricity demand worldwide, the companies responsible for transmitting and managing that power are already seeing strong earnings growth, while many of their stocks still trade at relatively cheap valuation compared to the broader tech sector. Overall, the AI boom is no longer just about software and semiconductors. It's starting to spread into energy, industrials, infrastructure, and raw materials, sectors that many investors are still ignoring. And if this AI build-out continues for several more years, those industries could become some of the biggest beneficiaries of the next phase of the market cycle.